Welcome back, guys and gals. This is the Northern Miner Podcast, and I am your host, Matthew Keevil. As always, we are brought to you by the Yukon Mining Alliance. Please swing by yukonminingalliance.ca and check out all the exciting exploration and development activity going on in the Yukon Territory. And anyone who lives in Vancouver will be well aware we've been snowed in or something. I don't know. This is crazy. I've been shoveling for like 3 days. I thought I lived in Toronto briefly. It was a scary situation. But anyways, so Merry Christmas and Happy Holidays. We do have a great show this week. I'm going to take it a little bit light on the macro. We expect everything to stay fairly even keel through the new year, when we'll get back to watching what might be going on in the wild world of commodities. But meanwhile, I do have some really cool content for you this week. Firstly, Lesley will be returning with an awesome episode of the Geology Corner. And this week, we get all Interstellar up in here. Lesley digs into the formation of gold in the universe. There is a lot of discussion on stars and briefly on Star Trek. But it's actually a really cool edition of the Geology Corner. And we'll run that first. And then after that, I have something great. We have one of our favorite guests back in studio. Well, not in studio, but on the show. Joe Mazumdar from Exploration Insights joins us at the coffee shop. And we have a discussion, fairly wide-ranging. Once again, usually when Joe and I sit down, it goes all over the place. But this week, once again, Joe and I have very good timing. Last time we did one of these, we got to talk about Rubicon and the Phoenix deposit, which everyone will recall from earlier this year was a big story due to their geology not hanging together and a huge amount of money being invested, and then the stock essentially going to zero, almost zero, one penny or something, I think was the low. So they essentially went nearly bankrupt. It is being restructured now, I believe. I saw some news the other week. Anyway, that's a bit of a tangent. Last week, people may have caught this news about Arizona mining, and there was an article published by a United Kingdom publication called the Global Mining Observer, I believe. And anyways, this publication on the company's Taylor deposit in Arizona, which is a zinc play, caused the stock to just get kicked and then kicked all over the place, like beat up all over the place. I think it was down at 1.60 cents on a $3 per share valuation, so significant. And anyways, this had to do with manganese content in their potential concentrate and the economic repercussions of such a byproduct. But anyways, Joe and I get into Arizona in a great amount of depth, and Joe, being an analyst himself prior to taking over a large portion of Exploration Insights, has some pretty cool things to say about the Arizona mining deposit, what the manganese can mean, and also a little bit of commentary on the article and just generally the response to it. So that's another really fun little segment. We'll also get into a little bit of investment advice heading into 2017, how to hedge on downside risk, how to leverage yourselves to stuff you might like, including gold. We'll get into all that fun stuff, and as usual, Joe and I have a great time. But before we get into that, I'm going to firstly run the Geology Corner, and I'm really excited. This episode is great. So without further ado, I'll leave it to Lesley.
Well, at the request of one of our listeners, he asked if I could kind of delve into the origins of gold. Mm-hmm. So, where did it come from? How did it get here? And most importantly, how we can find it. So it was really hilarious because I started looking for answers, right? And I ended up getting sucked into this black hole of information. And I'm being tossed around in all sorts of directions. And ultimately, I found myself following the stars in the universe.
Oh, no, Star Trek.
So kind of, yeah, best show ever. So as it turns out, the gold in our universe was born out of a star, and not just any star, right? But a really giant one that's weighing more than 8 to 10 times the mass of our sun and more. So in other words, we're talking about gold being born out of a big, bright star, brighter and bigger than most things seen in the universe. So anyway, the most important thing to know about the universe is this. So where water sustains life on Earth, gravity sustains the evolution of the universe. So in other words, gravity nurtures the formation of elements in all the matter that we know. So that's kind of cool. So I'll explain. The main element in space is hydrogen. So this is what the stars are originally made out of. And so the gravity pulls the hydrogen and dust floating about the universe into one point in space. And when the pressure from the gravitational forces builds up, it causes the hydrogen atoms to fuse together, and that forms helium, right? Nuclear fusion, all that jazz. So that nuclear process emits huge amounts of heat. So when we say that, or when we see that a star is like burning, it's not actually burning. It's not like a Yuletide log on the fire, right? It's just an exothermic reaction from hydrogen atoms like fusing together into helium. So once all this hydrogen is exhausted, the star starts to, like hunt for other fuel to keep it going, and it begins to fuse helium together, which turns into carbon and then oxygen, and eventually the elements are packed into something more dense like nickel or iron, chromium, cobalt. And this entire time when this process is happening, gravity is like always at work trying to crunch the star kind of in upon itself. But the thermal pressure from the reactions of all this nuclear fusion opposes the force of gravity. So the star, okay, is like sitting there all happy-go-lucky and burning and amazing. So much like life on Earth, though, stars do have a life cycle. So eventually there's nothing left for the star to burn. And gravity takes over and the star implodes. Okay, so this is the beginning of the creation of the whole origin of gold story that I'm going to get into. So it's where it gets really interesting. So, okay, for the star like ours, it's like the sun, right? It's really small. So when it dies, the outer layers of the star will fall inwards and it bounces off the solid core and then just blows out into the universe. Not a big deal. It's not that bad. The solid core that remains is actually called a white dwarf. And the majority of this universe, the stars in the universe actually dies like that. But in the case of these giant stars that we're talking about, it's so much more catastrophic. Of course, everyone knows it's called a supernova, or like when they explode, right? And so when it explodes as a supernova, and as the star collapses, the insane pressures that happen because it's so massive and the gravity is so insane, it forces the protons and electrons to combine to form neutrons. Okay, so what you end up isn't a white dwarf, but what you get is a neutron star. Okay, they're insanely dense. So if you can imagine, they'd be about 1.5 times the mass of the sun, but just the size of like a city, right? So now if a neutron star in the universe that's just kind of hanging around suddenly collides with another neutron star that formed from another supernova, then it's seriously so much mass coming together that the universe cannot handle it. And then all of a sudden you get a black hole that forms. But the cool thing is that the collision between those two neutron stars are so intense that it forces the neutrons and protons to combine, resulting in super heavy elements like gold and mercury and lead and platinum and more. And some of it manages to escape the black hole because it's like blown out into the universe and it gets thrown outward. And so that's how gold is actually made in the universe. It's crazy. Yeah. Now, what about Earth?
Yeah.
Okay. So this is it. It brings it to Earth. Well, we had our Big Bang supernova, 14 billion years ago. And then Earth clumped together out of this stellar dust and debris and began to grow until the interior of it was hot enough to melt the heavy iron elements, and all that sank to the core. So at the time, all the gold would have went down into the core with it, but instead we see proportionally a lot more gold in the upper levels of Earth's crust than we theoretically should have. And if you are an avid listener of this Geology Corner podcast, and you know that this is a subject I covered earlier called the Earth's slate veneer. The idea that during the first 500 million years of Earth's life, it was blasted by asteroids containing heavy metals like gold and you name it. And maybe it's like a black hole fallout from a nearby galaxy. I don't know. But that enriched the sea of magma that was Earth at the time just before it cooled into the crust, which is why we see proportionally more gold in the crust than before. So, this is the story. So the creation of gold in the universe stems from stars imploding and colliding upon each other by forcing, protons to protons joined together form neutrons and protons to form heavy elements like gold, and these elements are just gobbling up all this more neutrons and getting heavier and heavier until finally it just like collapses and blows out in dust, and then we get bombarded with all that stuff. And that's why we see more of the heavier elements near the surface of the Earth's crust than we do at the center, which theoretically is where it all should be. And but I really want to keep talking about the universe, because realistically, you know, I'll leave everyone with this. You know, all the gold deposits on Earth, they've all formed under an extremely unlikely set of perfectly timed conditions. And I think that's why maybe human civilizations have been so enamored with the yellow metal since like the dawn of time. And because I think perhaps like we look at gold same way as we see the Earth and the universe, you know, this extraordinarily rare and exceptionally beautiful thing that's born out of a star.
This is Matthew Keeble with the Northern Miner Podcast, and we are having a bit of a regular segment now, and I am calling it At the Coffee Shop because we continually do it at the coffee shop. I am once again joined by Joe Mazumdar from Exploration Insights. Joe, thank you so much for joining us.
Thanks again, Matt, for having me.
Maybe a little insight on what you see from the larger caps moving into next year.
Okay, I mean, even though the gold prices come down from that, midsummer peak of over 1,300, you know, the idea for getting quality projects that work at lower gold price environments is that most of the exploration, the limited amount of exploration done by majors, is in brownfields, close to where they already are, such that the hurdle rates are lower because they've already paid back their capital. It's just to keep the plant running, that sort of thing. And, you know, like companies like Newmont, I think I showed like 80% of their $200 million budget is all in brownfields. And really, Goldfields doesn't really have grassroots anymore. So the lack of grassroots sort of suggests to us that the ability to find grassroots is impeded. So you won't see a lot. And so if you're not seeing a lot of capital expenditures, where we've seen a significant drop in capital expenditures, then we're not going to see a lot of new production over the next 3 to 5 years. And if there's no grassroots exploration, then we're not going to see much new stuff coming in the next 5 to 10 years. So then for us, we're looking at, well, where are these guys going to find these quality projects that they need to make their hurdle rates of now at 1,200, 1,250 reserve prices with a 15% IRR? There's just not that many projects out there. Yeah. So then if you want to invest in the quality, then you got to be looking for the companies that are looking for quality projects, which would be the exploration companies or a development project that you see, a single asset one that you see could fit the criteria of the majors.
And it's interesting, I mean, something that comes to mind for me, and I'm not sure if you looked at this, was this G4 Capital thing with Sean Ryan, where Agnico took a big piece of essentially the Yukon again.
Well, this is interesting because my next PDAC talk I think I'll make around joint ventures and earn-ins, because the way you got to look at when you're investing in a company, you got to find out if they're earning into the project of a major, and sometimes they could, I don't want to say fool you, but give you the impression that the major is actually interested in the company when they are just trying to sell a project and the company doesn't have enough cash to pay them, which they would prefer, and all they want is to be paid, and so they end up with shares in the company. So a major might have 10% of a company because they couldn't pay them 100% cash, and that's what they've got. And we've, like when I worked for Newmont, that was the same situation. We would end up with these equity stakes in companies that we weren't really interested in the project anymore, but we ended up with shares. If you really want a footprint by a major saying that they're presenting a affirmation that this project may be something they're interested in, then you want to see that it's a proactive placement, not a passive placement from a transaction. You got to make sure you sort that out. And then after that, you're satisfied that it's a legitimate footprint. Then you got to look at, they're just taking an equity stake. They're not taking a project stake. And you got to work out, like in terms of dilution, there's two forms of dilution. At the denominator, where you dilute your shares to pay to work on the project, or you dilute the project out by selling a stake in it to a major.
Yeah. So, I mean, what sort of, as you guys move forward, what will you be looking for in the new year for investment?
Like, I think what we want to look for are probably the same thing that majors hopefully are thinking about, is major district scale projects that get them into a mining-friendly jurisdiction and giving them a footprint. And then what they would look at potentially as a starter project within that area that they could test the permitting, test the engineering, test what they need to do to get something that pays back capital quickly, and then know that they could grow it. And the big thing that I got out of my presentation that Agnico did, and I don't mean to keep talking about Agnico just because you brought it up, but they did present an interesting slide where when they acquire a company, it may look on a per ounce basis like an expensive acquisition, like a premium, but what they show and what they've done and executed is that every additional ounce they find post-acquisition is like a third or 25% of the cost of the initial acquisition. And so the whole idea is you buy, you pay a premium for what you know, and then you pay a severe discount for what you don't know, but you're going in there thinking that you can convert a lot of this area into ounces that will work for you.
And that's the message Goldcorp's done on coffee, repeatedly hammering that home.
And not only was it the vast project portfolio that they got from Kaminak, which actually was a prospect generator, and then turned out that they focused on one part of that project, and then they went for it. And Goldcorp's also putting footprints in the companies that surround
Exactly.
them.
Yeah. Independence Gold, for example. Exactly. And yeah, that's really interesting. I mean, it's something to watch for our listeners moving into the new year. Because I've heard, I think it was a CIBC conference that just happened, or Scotia maybe, and I'm hearing the same thing on the base metal side with Lundin Mining and First Quantum and Hud Bay, is that they're not really looking for advanced stage acquisitions anymore. They're more looking for earlier stage JV opportunities. They don't want to expend too much capital right now, but they are looking for promising exploration plays. So what we're saying in gold also seems to be playing out in base metals very much.
I would say finally and hallelujah, because this, if gold starts to follow these industries which are marginal cost that concern themselves with cost and returns, then the gold industry and the equities, which will be much healthier in terms of what they do. And I think going forward, if companies, I believe, are not looking for development projects that are near term, only because probably their investors aren't looking for a 3 to 5% compound annual growth rate anymore. Now they're fine with flat production profiles, especially on the gold producers, if they could show a higher return. And that philosophy and that mantra is really being pushed, such that companies before that would never sell production with no problem and focus on their core.
And that's basically what we've been hearing, sort of these corporate buzzwords now are quality ounces, and they're really focused on margins, right? Which is good, yeah. That's how you should be doing any business, really, not just mining. But
yeah, it's the difference between looking at accretive NPV, where $1 of NPV means the decision is yes to do it, rather than, hey, I need a 15+% return from this project.
And let's hope if gold prices rally, they don't revert back to their pure annual output figures where they're like, who produces the most gold?
And that could change. That could change because companies and investors are fickle. So what's really driving this, I believe, is not only the situation of the impairments, the lower gold price, the lack of free cash flow generation, but the understanding the way they can attract new investors is by showing return, so they can compete with other investment opportunities. But I would say it's unique to the gold mining industry, because when I worked at a base metal company, Phelps Dodge, it was all about cost and safety, whereas in a gold company, at that time it was about ounces, volume. But now the volume argument has changed to the profit mantra.
That's very interesting, because you're right. I mean, when you look at gold previously, let's say the last 5 years, reporting on gold was very focused on overall ounce figures. Whereas if you look at the copper industry, they're very focused on C1 cash costs, and they always have been, right?
And if we look at it, like we talk about geopolitical risk, again, I cite Agnico because this was a really good slide. What they were showing was, hey, look at my geopolitical risk exposure, and then I have the lowest exposure to high-risk jurisdictions. And look at how that translates into a PE multiple. And then they were showing how high they have a multiple. But what's interesting is the one that has the highest multiple is actually Rand Gold. And Rand Gold, interestingly enough, has probably the highest, or one of the highest, geopolitical risk profiles. But they have had a mantra of fiscal discipline for over a decade. And the investors have been paying for that for a long time. So that goes to show me that geopolitical risk matters up to a point. So if you have no fiscal discipline and have a lot of, let's say, triple A based assets, it doesn't really matter.
No, because the balance sheet won't be right. Yeah, yeah. And that's it's super interesting actually. And the one thing we did want to talk about today, because this has been bursting out on newswires since I guess yesterday, and in the media we heard about it extensively, was this Arizona mining thing. A blog, I guess, or a newsletter called Global Mining Observer out of the UK, I believe, posted an article that compared the Taylor deposit, they have a zinc deposit in Arizona, to Bre-X. And the headline said little Bre-X or something along those lines in air quotes. And the stock has been halted as we sit here today. It had fallen around 60 cents from highs of around $3. It's down around $3.25 or $2.25 now. So we wanted to talk a little bit. Now, the big issue that they sort of picked on here, and maybe you can talk to it a little bit, is manganese, I believe, in zinc concentrate. And apparently this is a big deal, and it just set off a wildfire. So maybe a little bit of discussion about why that would be such a big deal, if you can. Okay. And then also a little bit of comments on the market response to something like this.
So the Global Mining Observer is an independent mining news bulletin that's out of London. It's actually quite a good bulletin, and I read it. They've had really good interviews with CEOs like David Garofalo here, and we follow it. So what happened was, I believe it was last week on the Sunday, they came out with this article, and then the headline, like you said, was Bre-X-like, issue with a zinc developer. And the issue was that the manganese content within the concentrate might be, like they actually say it in the technical report, but they never cite it. The thing is that Arizona Mining, basically, after they did the technical report and the metallurgy so far, that they would commented on that we have no deleterious elements. And when they say deleterious elements, they could mean, I have no high arsenic, I don't have any high bismuth, I don't have any high selenium, I don't have any
things
high
that can
cadmium.
with the smelter.
Exactly. Penalties, or saying, okay, I got to blend you down. But they never actually commented on the manganese. And the manganese, and we've been talking amongst ourselves about this, was there's a certain amount of manganese that's required in a smelter, and they and that's a low level amount. I believe it's like 0.5 or 0.2. I don't know the percent. Yeah, much under 1%. But after you get over 0.7 to 1, it gets a bit too much. Okay. But the whole issue is about, and they're stating in their concentrate in the technical report on the table, which the Global Mining Observer quotes, is 1.3%. And so that seems kind of high. Yeah. But, the issue is that, hey, depending on the volume, you could potentially blend. But that's not to say that added requirement is not going to cost them a little bit more. So I don't think it'll totally, negate the high quality of the zinc con, which is, I think it's 50 to 55% con with not much deleterious elements. But then the manganese is an issue for running the smelter efficiently. If you have too much manganese, you can't run it efficiently. So the issue that they might have to is parcel it out to many smelters such that they could blend it individually, or find a bigger smelter that could take it all, but they would have to blend it against a lot of volume, against somebody else that's got very low manganese, which they need. Exactly. So the issue becomes, you have to do this. You have, and I think Arizona Mining should have got in front of it earlier. But saying that it's Bre-X, that's probably, a little bit overstated. But it wasn't them that said it as much as they quoted somebody who's
an investment banking community in London,
whatever,
somewhere,
somebody that's anonymous source that said that. And if you're going to say something like that, put your name down. Well, for me, a Bre-X issue is like fraud, corruption, just criminality, and this was an omission. Yeah, and you could say to them that, hey, you've got 1.3 and everything else I hear, this seems like a high amount.
The institutions love that stock, and I get a lot of the big it's a huge gainer this year, and you get notes coming down from all the big Canadian banks about it, and they love it. So it's interesting that something like this, like you're a former analyst, and it wouldn't pop to any of the bankers out there? Like, this isn't an issue that would pop?
Well, it's interesting that, you know, when we go over a stock, and I'm not naming names,
Yeah.
but when we say something, you know, it seems like all the analysts don't want to talk about it.
Yeah.
And so if we say something like, you know what, we don't think that grade matches that throughput, and then they would accuse us of saying, hey, you guys are making this stuff up. And so even though I don't agree with the Global Mining Observer, you know, quoting somebody who said that it was Bre-X-like, I do disagree with the point that, hey, nobody can say anything negative about any stock. So if somebody says something highly positive about a stock, why doesn't somebody say something like, hey, I think you're wrong?
Yeah, exactly.
I think, you know, you're blowing this out of proportion.
Yeah.
So we don't say much about when somebody's positively blowing something out of proportion, but we ram something down when somebody's negatively out of proportion. Then it becomes a legal issue.
You're
But
exactly right.
but I don't see a lot of companies saying that, oh, if somebody is promoting something over and above what they think it should be, they don't come out saying, you know what, I think that guy is actually saying something that's, you know, that's ridiculous, because there's no way my throughput's going to be like that. And there's no way my head grade's going to be like that. And we're going to have issues with the con. Well, I mean, we like to call PEAs, or preliminary economic assessments, pretty optimistic studies. So POS for short.
Yeah.
So, I mean, it's the only thing that can happen when you go to a PFS, or pre-feasibility study, or feasibility study, with that detailed engineering, you know, better metallurgy, better understanding of the cost, it can only get worse. Yeah, so the issue is that if you put up your first step is this, and that's like a scoping study. I mean, you've got inferred material, you got, hey, this is how big I can make it. But then the reality is that, you know, that throughput that you were putting in is now going to be 25% lower. And that head grade is going to be maybe 10 to 15% lower, you know, and the costs are actually going to be different. And, you know, hey, that permitting is not going to take 2 years. It's going to probably take 3 years.
Yeah, exactly. Yeah. And we talked about this in our previous episode where we discussed Rubicon and some of the issues with 43101s, and how people just have to be cognizant of A, the differences, and B, sort of the stage, especially like you said about the PEAs.
And if you look at behavioral economics, all you got to understand is anybody's motivation.
Yeah, exactly.
You know, what's your motivation to say this? And the Global Mining Observer is independent. And if their motivation is to shock, they definitely shock.
Yeah.
But from what I've read before, when what they try to do is just try to say things that, you know, seem that everybody's ignoring. I think they probably went overboard with the Bre-X comment, but I don't think pushing out the manganese issue, I don't think there's any problem with that.
Thanks again, Joe Mazumdar from Exploration Insights, for joining us this week. And please surf by explorationinsights.com and check out Joe and Brent's work. It's fantastic. They're both technical experts, so they do bring a lot to the table. And this has been the Northern Miner Podcast. I'm Matthew Keeble, and we'll talk to you next week.